Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Avis Budget Group Inc. Annual Report. Avis Budget Group Inc. offers a diverse range of businesses and services that cater to various customer segments. The company operates under several brands, including Avis, Zipcar, and Budget, which provide vehicle rental and mobility solutions to premium commercial and leisure customers. In addition to these flagship brands, the company also owns other car rental brands such as Payless, Apex, Magyar, Morini Rent, France Cars, Amico Blue, Turiscar, ACL Hire, McNichol Hire, Turis Prime, and Rubica. The services provided by Avis Budget Group include vehicle rentals for both cars and trucks, as well as car sharing through its Zipcar brand. The company's offerings are designed to cater to different customer needs, with the premium brands focusing on high-end customers and the value-conscious brands targeting more budget-friendly clients. With a global presence in the Americas, Europe, the Middle East and Africa, Asia, and Australasia, Avis Budget Group is well-positioned to meet the mobility needs of businesses and consumers worldwide. The company's extensive portfolio of brands and services reflects its commitment to providing customers with flexible and convenient mobility solutions. Whether it's for business or leisure travel, Avis Budget Group has a range of options available to suit different customer preferences and budgets. The stock price of Avis Budget Group Inc. has experienced a significant decline over the past year, with a change of -34.13% according to some reports and -30.67% according to others. This downturn can be attributed to several key factors. One major event contributing to this decline was the release of the company's fourth quarter and full-year 2025 financial results on February 18 and 19, 2026. The announcement led to a substantial drop in stock price, with Avis Budget Group's shares falling 18.29% and dropping 19.31% in pre-market trading. The negative stock performance can be attributed to several factors, including a substantial earnings miss, revenue shortfall, EV fleet impairment charge, and missed adjusted EBITDA guidance. The company reported a Q4 2025 EPS of -$22.25, significantly missing analyst expectations. Additionally, the full-year 2025 revenue declined by 1% from 2024 to $11.652 billion. The significant $518 million impairment charge related to the revaluation and shortened useful life of its electric vehicle, EV, fleet in the United States also contributed to the losses. Furthermore, the company's adjusted EBITDA guidance was missed, with a full-year 2025 adjusted EBITDA of $748 million, falling short of the previous guidance of $900 million to $1 billion. Despite expressing a focus on strategic initiatives for future growth, including fleet management, cost control, and customer experience, the recent financial results and associated news events have led to a considerable decrease in Avis Budget Group's stock price over the past year. Avis Budget Group, Inc. market capitalization of $3 billion is materially smaller than most of its industry peers of roughly $17 billion. Avis Budget Group, Inc. trades at a lower price-to-book ratio of -1.42 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation, signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 108% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has aggressively reduced its share count despite weak revenue growth. This raises concerns about whether buybacks are being used to offset underlying business challenges. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for Avis Budget Group are closely tied to its core business operations. Vehicle rental activities are a significant contributor to the company's revenue, with factors such as demand, pricing, and competition playing a crucial role in determining revenue levels. A key indicator of potential revenue growth is the increase in assets under vehicle programs, which suggests that the company is expanding its fleet and infrastructure. Additionally, the rise in net long-lived assets indicates investment in the company's future growth prospects. However, impairments and charges can negatively impact revenue and profitability, as seen in the significant write-downs of goodwill and other intangible assets. External factors such as demand for vehicles in the used vehicle market, pricing for vehicles, and manufacturers' ability to honor their obligations also play a role in determining revenue levels. Overall, Avis Budget Group's performance is influenced by a combination of internal and external drivers, making it essential for the company to monitor these factors closely to ensure sustained growth and profitability. The net income of Avis Budget Group Inc. experienced a significant decline between 2023 and 2024, decreasing by $4.5 billion to -$2.6 billion. This substantial drop in net income was accompanied by an increase in net loss, which rose by 45% from 2024 to 2025. The company's profit margins also underwent changes during this period. The operating expenses as a percentage of revenues decreased slightly from 51% in 2024 to 50.3% in 2025. However, vehicle depreciation and lease charges increased from 25.2% to 25.9%, while selling, general and administrative costs rose from 11.5% to 12.4%. These changes in profit margins can be attributed to various factors. The company incurred long-lived asset impairment and other related charges of $518 million due to a change in fleet strategy. Ongoing military conflicts also contributed to uncertainty and volatility in costs, including fuel and fleet expenses. Furthermore, increased costs as a percentage of revenue from lost property leases or vehicle rental concessions added to the company's financial burden. These factors collectively influenced the decline in net income and changes in profit margins. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. The data shows that the company has achieved positive operating cash flow of $3,296 for the year ended December 31, 2025. This is a notable milestone, as it signifies that the company is now generating more cash than it is consuming through operational activities. This achievement can be attributed to various factors such as improved efficiency, cost-cutting measures, and enhanced revenue streams. The positive operating cash flow will enable the company to invest in growth initiatives, pay off debts, and reward shareholders, ultimately contributing to its long-term sustainability and success. The company's debt level has experienced significant changes over the past year. As of December 31, 2025, the total outstanding debt stood at $25.4 billion, a notable increase from previous years. The unhedged interest rate-sensitive debt peaked at $6.2 billion in 2025, indicating a substantial rise in this category. The company's interest expenses have also seen an upward trend. In 2025, the net interest expense related to corporate debt reached $422 million, marking an 18% increase from the previous year. Furthermore, liabilities under vehicle programs increased by 9.6%, with the percentage of total assets under these programs rising to 108.4%. The issuance of senior notes due June 2032 at an interest rate of 8.375% also suggests a higher level of interest expenses. While there are inconsistencies in the data provided, it is clear that both debt levels and interest expenses have increased significantly over the past year. The recent market analysis reveals a mixed performance across various segments and regions. On the positive side, the Americas, North America, and Australasia have shown strong growth, indicating a thriving market in these areas. These regions have demonstrated significant progress, with notable achievements highlighted on page 4 of the report. In contrast, there is limited information available for the international segment and Europe, making it difficult to assess their performance. This lack of data suggests that these regions may be experiencing challenges or are not yet fully represented in the market analysis. Management is emphasizing the importance of driving sustainable growth through operational efficiency, analytics, customer experience, and innovation. This strategy aims to reinforce the company's competitive position and support long-term profitability. Specifically, management is focusing on reducing the age of fleet by shortening the useful life of certain EV rental car vehicles in the U.S. and accelerating fleet rotations. Management is also aware of various external factors that may impact the company's results, including interest rates, inflationary pressures, cost of new vehicles, used car values, personal injury claims, government shutdowns, manufacturer recalls, economic downturn affecting travel demand, ongoing military conflicts, and uncertainty around tariffs and tax regulations. These factors highlight the challenges facing the industry. Despite these external challenges, management is committed to reinvesting undistributed earnings of foreign subsidiaries into their operations indefinitely. This move demonstrates the company's confidence in its ability to navigate through uncertain times and maintain a strong financial position. The company has made several acquisitions and divestitures as part of its business strategy. In terms of acquisitions, the company has entered into a transaction with Interpace Ventures, acquired existing licensees or investments in related businesses, but no specific details are provided for these transactions. On the other hand, the company has divested certain assets, including the disposal of a fleet in the Americas reportable segment. Additionally, the company has planned to rotate its fleet in 2024, which implies the disposal of some assets. However, there is also mention of shortening the useful life of EV rental car vehicles in 2025, but this does not necessarily imply an acquisition or divestiture. In recent years, the company has taken steps to reward its shareholders and return value to them. One way it has done this is through dividend payments. In December 2023, the company made a payment to its shareholders, marking a significant milestone in its commitment to shareholder value. The company has also implemented a share buyback program, authorized by its board of directors. This initiative allows the company to purchase back shares from the market, further reducing the number of outstanding shares and increasing earnings per share for existing investors. The extracted summaries reveal several concerns regarding inventory buildup and supply chain disruptions that could impact a company's operations. One of the primary concerns is the fluctuating supply of rental vehicles, which can lead to substantial losses due to reduced residual values. Furthermore, auto manufacturers are curtailing production due to various factors such as pandemics, tariffs, shortages of parts, and supply chain disruptions. This reduction in production can have a ripple effect on the entire supply chain, leading to inventory buildup and potential losses. Additionally, external factors such as fuel costs being impacted by sanctions or embargoes, fleet availability being affected by military conflicts, and disruption of asset-backed financing and slash or credit markets are also concerns that could lead to supply chain disruptions. Overall, these concerns suggest that there are potential issues with inventory buildup or supply chain disruption affecting the company's operations. That concludes the financial summary for Avis Budget Group Inc. Feel free to comment below, and I will be happy to answer them when possible.